Peter Lynch is one of the most successful and well-known investors of all time. Lynch is the legendary former manager of the Magellan Fund at the major investment brokerage Fidelity. He took over the fund in 1977 at age 33 and ran it for 13 years. His success allowed him to retire in 1990 at age 46. His investment style has been described as adaptive to the prevailing economic environment at the time, but Lynch always stressed that you should be able to understand what you own. In 1977, Lynch took over the Magellan Fund, a small, aggressive capital appreciation fund created in 1963 that held mostly domestic investments. An investor who put $1,000 into the fund the day Lynch took over would have had $28,000 the day he left. Under his management, the fund returned an average of 29% per year and outperformed the S&P 500 for all but 2 years. Many investors commonly point to Lynch as an example that active management can achieve superior results relative to the benchmark. At age 25, Lynch got his first full-time job as a textiles and metals analyst at Fidelity. One of Lynch's first successful investments was in an air freight company called Flying Tiger, which helped him pay for graduate school. He earned a Master's in Business Administration, MBA, from the Wharton School of Business at the University of Pennsylvania in 1968. He served in the Army from 1967 through 1969. According to Peter Lynch, these are the 10 trading mistakes every trader makes. Number 10. It's always darkest before the dawn. In 2014, U.S. shale oil created a boom in domestic oil production, propelling the United States to become the #1 crude oil producer. When the oil prices fell back in 2015, the producers just kept pumping more oil to make their payments. Low interest rates meant the companies could survive by servicing the interest on their debt and refinancing. The hope always was that they would eventually come back. This time around, with the oil price falling due to oversupply from Saudi Arabia and Russia, there is no sighting of the dawn. There is no fat to cut around balance sheets as companies are already operating with minimum costs, and there is so much money that could be borrowed. Around 200 companies have gone bankrupt between 2015 and the present, and the current economic situation does not look promising at all. Number 9. The typical big winner generally takes 3 to 10 years or more to play out. New investors can be easily overwhelmed by the 24/7 financial news flow that is turned into infotainment. Much of TV programming suggests investors must act now in response to a poor quarterly report or even a short-term setback. But such action generally does more harm than good. Despite what the stock market wants us to think, we cannot measure a company's success over a single quarter or year. Look back at the best companies in the stock market, and you will find that it takes time for them to execute their winning business strategies and achieve full potential. Number 8. The stock's gone up. Lynch says this is the great single fallacy of investing. When you pick a stock at $10 and it goes up to $12, you pat yourself on the back that you have made a good choice. If you do not sell at that time, thinking that the prospects are good, and it goes down to $8, then you have made a loss if you sell at that point. The price going up and down just means that there is someone else at the other end who is willing to purchase or sell the stock to you, and it gives no idea about the prospect of the company. Many of the high-flying stocks that trade for high prices are just like the game of musical chairs. The shares keep trading, and once the music stops, the one holding them will be counting his losses. Number 7. If it's gone this high already, how much can it possibly go higher? Microsoft, MSFT, is a classic example where it was lingering in the $20 for quite some time. The company was going nowhere in terms of business strategy, with the old PC licensing model looking outdated. It had a decent market cap, and no one expected it to grow any further. MSFT had seen its day and had turned into a slow behemoth company. The important thing is to check the fundamentals and the growth story. If they are sound and you find a long runway ahead in terms of growth, grab the stock with both hands. Number 6. In the stock market, the most important organ is the stomach. It's not the brain. Our intuition about investment opportunities is usually on target. The hard part is ignoring all the market noise and sticking with stocks even when things look and feel grim. Knowing that volatility is a feature of the stock market, the superior returns you get from investing in stocks come at a cost, enduring the inevitable ups and downs in the overall market and the share prices of the companies you select. Hence, remind yourself that the stock market volatility is normal and that sitting tight and taking a long-term approach to invest can help you avoid losses and come out a winner. The real key to making money in stocks is not to get scared out of them. Number 5. Real estate markets. Today, we have some very difficult commercial real estate markets, especially in Arizona. Right now, residential mortgages are doing fine in Arizona. People who moved to Arizona for a certain reason, they're still there. 1,000 people a day are moving to California. Companies like Fannie Mae, companies like Freddie Mac, Beneficial Corp, Primerica, Golden West Financial. The average mortgage is only $80,000 for these people. They have 65% loan to value. These are very strong positions. The average house rose 4% so far this year to $90,000. Number 4. You can always tell when a stock's hit bottom. This is called bottom fishing, where investors try to scoop shares when the price hits bottom. But no one actually knows what the bottom is. A lot of times, falling stocks are like falling knives. If you grab them, your portfolio may take a big hit. It usually takes 2 to 3 years for the price to bottom out, and if the company has a good balance sheet and prospects, the price may then start an upward march. Number 3. You want to buy in the second or third inning and get out in the 7th or 8th. Unlike most investors, Lynch looked for growth in small and almost unknown companies, waiting for them to rapidly compound. His reasoning for staying small and under the radar is simple. Small is where the growth is, or as Lynch puts it, big companies have small moves, small companies have big moves. Lynch bought Hanes stock during his time at Fidelity because his wife brought home a sample of their new product called Legs, and after wearing them raved about how great they were. Legs stole market share from cheap drugstore competitors, and Lynch eventually made it one of Magellan's biggest holdings. Eventually, Legs was bought by Consolidated Foods, which is now called Sara Lee. Magellan fund holders benefited from a 30-fold appreciation in Hanes' stock. To achieve multi-baggers returns like Lynch, investors must be willing to look past hot companies. He reasoned that they would attract too much attention, which would bid up stock prices and attract competitors. Number 2. You should follow same industry. You only need 1 or 2 good stocks a decade. You don't need a lot of action. People are so confused about that element. When you put $1,000 in a stock, all you can lose is $1,000. I've proved it a lot of times. But you can make $10,000. You can make $15,000. You have to be patient. It doesn't happen in the first hour. For some years, nobody can understand it. You lose money fast in the stock market. You can't make it fast. Number 1. If it's gone down this much already, it can't go much lower. Circuit City, the electronics retailer, was trading at a peak of $30 in May 2006 and fell to $8 in December 2007. Many people thought about how much lower could it go. Some even doubled down the shares at this price. Then it fell to 10 cents a share in November 2008. There were many mistakes made in the operations of the company. The locations chosen were not prime, and most of them had either a Best Buy or Walmart at a stone throw's distance. The customer service was very bad. The working capital was getting stuck in inventory due to bad inventory management, thus giving no cash flow. Let us know your opinion in the comment section below. This was all for today. Hope you liked the video. Do not forget to subscribe to our YouTube channel. Hit the bell icon for more updates and notifications. Stay safe, and we will be back soon with another video.